Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just now to go until the closing bell, and stocks are lower here. We have the Dow down about 100 points, S&P 500 is down about 0.8%, NASDAQ now down more than 1%. Let's welcome in now Jared Blickery, joining us to break down the headlines. Jared, what are you seeing in the markets?
This is a big turnaround to the downside from what was looking to be a very promising day, a turnaround based on the jobs report, but more because of that NVIDIA beat yesterday. But now we're seeing the Dow in negative territory, down about 1/3% to 1/4%. And you can see we had some gains early on, and those have been given up. NASDAQ is a much more extreme example of this. We were up almost 1.5%. Now we're down 1.25%. S&P 500 kind of splitting the difference between those two. But I want to draw your attention to the NASDAQ 100 because the NASDAQ started the day up 2%, and then at the lows here, which were not that long ago, it was down 2%. And that is a very rare pattern. I looked back in history, doesn't happen that often. Usually happens when we're way off the highs, not 7% off the record highs the way we are now. So it's an unusual situation, and a few things that I've been noticing throughout the day. I actually want to dial up the Bitcoin chart right now because it was about 11 a.m. Eastern when Bitcoin finally cracked 90,000. That kind of led to some risk-off sentiment in other markets, I think. And am I trying to say that Bitcoin is a reason stocks are down and they turned around? I think it's a confluence of factors. I think the job report under the hood wasn't that great. I think investors are worried about the Fed probably going to skip that December rate cut right now. And then tomorrow is options expiration. So check out what the VIX is doing right now. Something called negative gamma happens when the market is down, heading into a big options expiration, and dealers have to hedge their position when the market goes down by selling more into the market. So suffice to say, there's a lot of different factors going on right now. I think it's kind of a perfect storm that has resulted in this big turnaround that we've seen today. But here's the SIBO VIX volatility index. Here's a 3-month chart, and you can see we are now on track for the highest level, the highest close at least in the VIX that we've seen probably since, and this is a year to date now, since April. And you can see we were much, much higher in April. So this is not panic mode, but it's just a confluence of things that I've been tracking here. And we check out the sector action. Leading to the downside is tech. It's down 2.35%. This morning around the opening bell, I was reporting it was leading the day. It was up by about 2 and 2.5%. So big turnaround here. Staples and real estate, the only two sectors that are in the green. Utilities just kind of flirting with the unchanged there. So very defensive setup. And I'll just show you the NASDAQ because everybody wants to know how NVIDIA is doing. Started the day off about 4%, 5% to the upside. Now it is trading to the downside by about 2%. So big reversals all around, Josh.
All right, thank you, Jared. Appreciate it. Well, that brief market rally following NVIDIA's blockbuster earnings report losing all its steam. Stocks on track to close lower now as investors begin to doubt their rate cut bets following that stronger than expected September jobs report. Joining now on the latest market action, we got Ross Mayfield, Baird investment strategist. Ross, always great to see you. So big swings today, Ross. You know, we got NVIDIA. It's a strong earnings report. We pop. But then we roll over. Now we got red all over the place. Help us make sense of it, Ross. I know some folks are pointing the crypto market, but what do you see?
Yeah, I'll highlight 3 things quickly. I think number one, demand for NVIDIA chips doesn't answer the big question about this AI rally, which is what is the return on investment for the firms buying the chips, right? That NVIDIA has such strong demand shouldn't be a surprise. The question is, where's the killer app, the productivity enhancements? Is there going to be good ROI from the hyperscalers and all the folks downstream spending on the NVIDIA chips? I'm not sure why NVIDIA is down so much. I think it looks pretty attractive here, but it doesn't answer the big question about AI. Number two, I think the market is worried the Fed is trudging towards a policy mistake, that they're going to hold firm in December, that it's going to be a hawkish hold, and that the labor market is deteriorating in a way that requires cuts, or at least for the Fed to get back to a neutral policy stance. There's no real upside of pressure from inflation. Tariffs haven't proved inflationary. And you've even got this working paper making the rounds from the San Francisco Fed that shows tariffs have been deflationary in the past. And then third, you get downside momentum, you get volatility spiking. It starts to trigger some of the algorithmic trading, some of the vol hedging strategies. And it's hard to kind of break out of that cycle without a cleaner bottom, without a real capitulation. So I think we could have a little more downside pressure here, but I view it against the backdrop of a bull market where these sorts of dips are buyable until proven otherwise.
Let me go back to what you said about NVIDIA, Ross, because that's interesting. So if that core AI question, as you put it, isn't answered by that print, what are the investment implications of that, Ross? You know, how does that sort of shape how and where I want to put money to work?
Well, look, I mean, we've all heard the analogy about, in a gold rush, you want to own the seller of the picks and shovels, right? That's NVIDIA. So we know that there's incredible demand for their product and for for any company that provides products that contribute to building out the infrastructure, right? The question is whether the hyperscalers and even downstream of the hyperscalers, pick a random staples company, are there productivity enhancements coming from all of this spending on things like NVIDIA chips? We know the demand is there. The question is the return on investment, and particularly at a time where the market is getting uneasy with how that investment is being funded. For years, the Mag 7 were, cash heavy, debt light. They're starting to reverse that trend and borrow to make these investments. So we might be years away from seeing the results of all this spending, whether there's a killer app or productivity enhancements down the line. It took really decades to get there for the internet boom in the late 90s. But that's the big question at the heart of this anxiety. And the NVIDIA print, while great, doesn't go a long way to answering that.
I also want to talk about the earnings growth you mentioned here. Strong earnings growth. The S&P 493, you point out here, Ross, earnings up 12% year over year. What should we make of some of the improving trends, Ross? You highlight, you point out healthcare, energy, banks. What should we make of that as investors?
Well, I think it's a good thing, right? I mean, if market concentration has been the big worry for most of this bull market, you like to see a broadening or at least some rotational action when big tech isn't pulling its weight. We're seeing that a little bit. Now, obviously, from a headline perspective, it's tricky because tech is such a big weight that it can't really pull you out of a tailspin. But we like to see the strength from healthcare, energy, and financials, pulling their weight. And even if you zoom out, from a global sense, the US is not the only market that's been working. This is a global bull market in almost every sense of the word. So the broadening in terms of earnings, the broadening in terms of price action, it might take a little while to work it out. It's not like the S&P equal weight has been leadership by any means. But it's encouraging nonetheless that this is not just AI, not just big tech. And again, that broad earnings growth, I mean, the S&P equal weight is trading probably as of right now below its long-term, next 12 months price to earnings ratio. So, it doesn't look expensive. It doesn't look bubbly to me.
As for the Fed, Ross, you say a higher for longer rate environment here to stay. If that's true, Ross, what are the sectors, the asset classes that you would say, okay, those would be your winners and the losers?
Well, I think winners, when you're thinking about something cyclical like interest rates, you're looking at companies in sectors that don't have to tap capital markets all that much, that do have a lot of cash on their balance sheets. I mean, up until recently, you would have said, well, big tech, these behemoths are a natural winner from a higher for longer rate environment. Losers would definitely be, both the yield proxies, things like staples, which have really, outside of the day failed to catch a bid across the last couple of years. And then the more rate sensitive sectors, I think about small caps, which have a lot of floating rate debt on their balance sheet. I think about the housing sector, which has just been desperate to break out, and you see signs of life, and then you get mortgage rates popping back up. So there's more, I would say, losers than winners from a higher for longer rate environment, especially as we kind of come off a decade where zero interest rate policy was the norm. So we still like big tech. We still like the secular winners that have to do with the AI trade. I think there's plenty of things to like, but that higher for longer rate environment is a bit of a wake-up call, especially compared to last decade.
Finally, Ross, you did mention there how you would encourage investors to diversify internationally. Are there certain regions or sectors, Ross, overseas that you think look the most compelling right now?
Yeah, it's a good question. I mean, from the highest perspective or the highest level, we would say diversify internationally. It's under-owned for sure from U.S. investors. And part of the appeal is there's not as much tech exposure, right? They have a different sector profile. So you get, both some dollar hedging by owning international assets. You also get some hedging on the sector front in events like this where AI and tech is the big leader to the downside. Places that have, shown some leadership, I think Japan, breaking out to new highs after 34 years underwater has been a real leader. There's a lot of structural reform and fiscal stimulus there. I think Europe is another one where you've got some leadership from some of the European banks, some of the luxury stocks, as well as you have a kind of a fiscal tide change in the way they're thinking about policy making. So I like, developed markets, Japan, Europe, I think are good places to be. But in reality, you can own the whole thing because of the sector diversification and because of the potential for a weaker dollar over the next couple of years. It's really a rising tide that lifts all boats when it comes to international.
Ross, we'll leave it there. Thank you as always for your time, sir.
Thank you.
Coming up, Kevin Hassett, the director of the U.S. National Economic Council, weighs in on the health of the labor market. The long-awaited September jobs report came in much stronger than expected. Payrolls rose by 119,000 a month, though the unemployment rate ticked up to 4.4%. Yahoo Finance Fed correspondent Jennifer Schonberger sat down with Kevin Hassett, the director of the National Economic Council. He reacted to that jobs report, affordability challenges, and the possibility of being named Fed chair.
I think that if we look at the payroll side, that's correct, that there was outsized growth in education and healthcare workers. Sometimes we see that around September because of seasonals with people coming back to school. But it is true that there's been a sectoral increase over time of demand for healthcare workers. And I think that that's a trend that will likely continue. The thing that jumped out at me that I thought was very interesting in the report was a big surge in construction employment. One of the things that was a high priority for us when we passed the big beautiful bill was expensing factory construction, and so the fact that we're beginning to see people breaking ground on all those new factories that we expect to come up over the next year or two is a really positive sign for the outlook going forward. I think if you look at GDP now, it's running at 4.2% now for the third quarter, and it was about 4% in the second quarter. So that you could say that coming into the government shutdown, this jobs report shows us that it was full steam ahead, this economy, about as good as economy gets. On the unemployment, I think that there are sort of two times as an economist when you look at the unemployment rate where you have to decide what you think about it. There are two ways that you can think about it. One is if labor force participation goes down and unemployment rate goes up, that's a really bad sign. Because what it means is that people are getting frustrated and they're giving up trying to find a job. If labor force participation is going up and the unemployment rate goes up, it could be that it's actually a whole bunch of people who came off the sidelines and they're looking for a job, but it's actually good news because of the labor force participation, not, of course, because of the unemployment rate. And there's a big uptick in labor force participation in this report, which suggests that, the full steam ahead economy that we've created pretty much since we passed the big beautiful bill is getting people off the sidelines and making them look for work. And so if you figure that we got construction people building factories and people cut off the sidelines and looking for work, you'd have to say it's a really strong report.
To your point, Kevin, there were some concerns that the labor market had been weakening until we got this report, putting a rate cut on the table for December. Now that we've gotten this report, looks like that's becoming less likely. What's your reading, and what would the administration's reaction be to no cut in December?
Well, I think that if we look at the news that we got before this report, and don't forget this is a September report, the news that we got between the meeting 2 meetings ago and the last meeting of the Fed, and recall that 2 meetings ago, the Fed was saying, yeah, we're going to cut 3 times. It was pretty much priced into federal funds futures markets. Well, the news that we got subsequent to that meeting, in between the last 2 meetings, was that we had a government shutdown that's going to reduce GDP growth by 1.5%. And we had a consumer price index report that was way better than expected. In fact, it was lower than 48 forecasts that were people who were surveyed at Bloomberg. And so if you've got, before this report, a whole bunch of stuff that would argue in favor of another cut, then you'd have to ask yourself, is this cut, is this and jobs report, is it large enough so it would offset that other news? And I don't think that that would be prudent. I think that the headwind for the fourth quarter is really strong. The shutdown came at just about the worst possible time. I've had airline CEOs coming in and talking to me about how disruptive the Thanksgiving holiday travel season has been, because people will be booking their flights for Thanksgiving, and a whole bunch of people decided not to go on Thanksgiving. So I don't really think that we have a full handle on how destructive this shutdown will be for fourth quarter GDP. We're super optimistic about the future, but I think it would be a very bad time for the Fed to pause.
So it sounds like you think we could see some slowdown here in the fourth quarter before a bounce back next year. I do want to ask
Because
you,
of the
though,
government shutdown, yeah.
Yeah, I do want to ask you, though, because the president hinted on Tuesday that he may be starting to talk to Fed candidates for the next Fed chair himself. I know you are on that short list. In fact, you are the favorite right now, according to Polymarket. Have you spoken to the president about this? And if you were selected, what changes would you make if you were Fed chair?
I'm not going to talk about discussions I have with the president. That's one of those things you don't do when you're a White House advisor, regardless of what the topic is. I can say that I'm humbled to be on the list. There's a lot of great folks there. And I think that probably each and every one of them, like me, puts a high priority on Federal Reserve independence, on sound money policies, and getting interest rates aligned with the data. I think to the extent that I'm old friends with Jay Powell, to the extent that we've had disagreements, it's not because he's a bad guy. It's because I think they've made some bad policy decisions. And they've made policy decisions that look to me to be at times partisan. So if you think about it, when President Trump's first elected, then even before he's inaugurated, the December before, they start hiking rates. When we had the Tax Cuts and Jobs Act, which was a supply side tax cut, which should give you growth but no inflation, they started raising rates. And then when Joe Biden came in and spent like a drunken sailor and gave us inflation, they told us it was transitory, didn't do anything about it. In fact, they didn't start hiking the rates to control inflation until after Jay Powell was reappointed by Biden. And then they gave us these surprise rate cuts right before the election, presumably to help Kamala Harris. I think that there's a lot of house cleaning needs to happen at the Federal Reserve, and I'm confident that anyone the president chooses will get to work and try to fix it and make the Fed independent again.
Switching gears a bit, the jobs report showed that wage growth grew by a strong clip of 3.8%, so a good deal above the inflation rate of 3%. Yet Americans still feel that prices are too high. In a new Fox News poll, it shows that some 76% of voters view the economy negatively, and fewer than 1 in 5 think that inflation is under control right now. I know last week you took some initiatives to announce that you are going to lower tariffs on beef, coffee, nuts, spices, and dozens of other agricultural food products. Could we see other tariffs brought down or other carve-outs as you look to improve affordability?
Well, I think that first talking about how people are feeling about prices. You have to go back and remember that we had, more than 20% inflation over the Biden years, which really caused significant harm to people's lives. And, really, one of the most striking numbers for me that really takes it home is that the typical average mortgage payment when President Trump left office last time was about $1,300 a month for the typical median home. And it jumped because of inflation and higher mortgage rates to $2,500 a month. And so for their homes alone, and you imagine a lot of people have adjustable rates, so they would have experienced a lot of that. For just like getting your house that you then have to put the groceries in, the cost of it almost doubled under Joe Biden. And so, we're reducing inflation, we're cutting the cost of things because we've got a fiscally responsible plan again, and we've reduced the deficit quite a bit this year. Mortgage rates are coming down, but the hole that was dug is enormous. For groceries, I'll go to groceries as well. A typical family in President Trump's last year, spent about $400 a month on groceries. Under Joe Biden, it jumped to about $515 a month. And so they're doing that while their mortgage payment goes from 13 to 25. Of course, there's a lot of work still to be done. But the hope isn't just hope, it's just like practical, I guess, historical evidence is that we're going to fix this. And the way to think about it is that the way you fix this is you get incomes to go up a lot more than prices. And under President Trump in the previous term, you might recall that we got incomes up right before the COVID shutdown. Incomes were up by about $6,500. And so we expect that we can outperform our first term. And if we do, then all of these pocketbook issues will be solved.
But do you think, or could we see other actions, other tariffs being brought down, other carve-outs to help with affordability? Is there anything in the pipeline, anything on the table right now?
Well, I think that there are people who come to U.S. Trade Representative Jameson Greer every day with requests for changes in the policies. The bottom line is that the purpose of the tariff policy is for the U.S. to onshore production for the things that we can make here, and to make our economy more secure and get the jobs to be created here. And so for some things like bananas and coffee, that was never really the intent of the policy. We're not expecting that we're going to all of a sudden have lots of coffee growers in the U.S. I know we've got some great ones in Hawaii, but they don't have the kind of capacity they do in Brazil.
Before I let you go, the president said yesterday at the U.S. Saudi investment conference that he's looking at doing a dividend for the middle and lower class income brackets he said, at least $2,000. I know this would need legislation to pass, but is the administration looking at checks of more than $2,000? And while this would help cushion Americans' pockets and help with the affordability issue at the present time, do you worry that that could also be inflationary versus rolling back tariffs?
Well, if you look at what's happened since President Trump took office relative to last year on a year-over-year basis, the deficit is down about $400 billion because of spending reductions, tariff revenue, and surprisingly high tax revenue because we've got a real growth dividend going on right now. And so if we're on track to have about a $600 billion reduction, that's going to be $6-7 trillion over 10 years because of a little bit of growth, then there's room to give more help to people who need it the most. And I'm sure that that's something that President Trump and congressional leaders will discuss as we think about maybe having another reconciliation package this year or next.
More than 2,000, though?
We'll see where it ends up.
Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joined me here for a look at Cracker Barrel, Bath and Body Works, and the TJX companies. We're going to start off with Cracker Barrel. Company shareholders vote to retain its CEO, Julie Masino. So this is interesting. They vote to retain the company's CEO after that rebranding fiasco. But as the Journal notes, here's what the Journal puts it, they sent the board a clear message of discontent because, they vote to keep the CEO on the board, but the marketing and diversity specialist did not receive the necessary votes to stay on board and has resigned.
Yeah, one of the board members did not receive those votes. They are, like you said, they have to resign now. And so it's interesting to see the CEO, Julie Masino, stay on board here despite this turmoil that happened in the late summer. And it's funny because I actually started the year at the ICR conference down in Florida, and I spoke to Julie Masino, and she had all these plans about how she was going to revitalize the Cracker Barrel, ultimately the company and its legacy that it's built, known as this like roadside chain. And she, was talking to me about bringing in younger consumers and really catering towards modernizing the chain. And after this turmoil that she faced in late August, sure, Cracker Barrel got lots of attention, but then once we heard from the company is that they ultimately led disappointment among the street. Investors were disappointed by the restaurant chain's decision to this conversation that they had expected to drop in traffic. They said lower sales. And there was some, I don't know if you remember that word, that hubbub that this created that might actually drive more foot traffic to the chain. And so certainly the decision to keep Julie on top definitely is more of the company looking to get more traffic in the door and maybe, after that reversal, more of the same here.
Yeah, the stock chart says it all. That stock has been shelved. It's down about
Yeah.
50% this year now.
Right.
Yeah. All right, turning to Bath and Body Works, shares of the retailer sinking after the company signaled that declining sales trends would continue to weigh on fourth quarter results. So they did cut the full year adjusted EPS forecast, Brooke. You're talking negative consumer sentiment. They now see adjusted EPS of at least 287. Consensus was 342, so that is not going to cut it.
Yeah, and speaking of a stock that has not performed well, this is one of them. And keep in mind, we did get a new CEO at the helm of Bath & Body Works just a few months ago, earlier this year, but the stock is still down 60% year to date. And on the call, Bath & Body Works CFO sort of hinted at what we've been hearing from other retailers. They said macro consumer sentiment is weighing heavily on consumers' purchase intent, and they also announced all these plans to get consumers back in the door. A consumer-first formula, they're calling it. They're going to create disruptive and innovative product. They're going to reignite the brand. They're going to win in the marketplace. And ultimately what they said, maybe a mistake, was that they tried to get more younger consumers in the door. Sounds a lot like what Cracker Barrel maybe, is trying to do here. But ultimately this did lead the street to cut some price targets. We did hear from Bank of America. They cut their price target from $40 to $32. And so definitely some pause in momentum. But keep in mind, this stock still has 10 buys, 6 holds on the street. So definitely some optimism there.
For sure. All right, lastly, TJX seeing a bit of a pop as Wall Street gets a little bullish on the name following its quarterly results. So my man, the great Jeff Mackey, all right, there's a man who knows retail. He posted this on X. Here was his take. It says, TJX, awesome. Better than other retailers right now, better comps, margins, and EPS. Mackey saying perfectly positioned, executing on point.
Execution on point, and that's certainly what we've been hearing on the street as well. We did get 2 price target raises from both Telsey Advisory Group, Dana's Telsey, as well as Bank of America. Dana Telsey now, her price target's at 170, up from 155. Bank of America at 168, up from 150. And what we're hearing across the street is that this is the winner here. Of course, we'll hear from Ross Stores, but this is the company that really is able to play into this environment where consumers are seeking out value, and it's not just those low-income consumers who are seeking out value, it's all income cohorts. Dana Telsey pointing out in her note that TJX, unlike maybe a Target, they're confident heading into the holiday season. Management said that they expect to drive sales and transactions going into Q4, despite up against a difficult comparison from last year. They think that they'll continue to win big, especially in this environment where everyone's looking for a good deal. You think about the offerings here. You have Home Goods, you have TJ Maxx, you have Marshalls, and it's the plethora. I'm always surprised at just how much are in these stores to cater to everyone.
Hubbub, plethora, coming in hot.
I mean, I got all the buzzwords, Josh.
I love it. Coming up, we zero in on the health of the economy next on Market Domination. Mortgage rates show little movement, shifting within a narrow 10 basis point range over the last month. Yahoo Finance's Claire Boston joining us now with more. Claire.
Hi, Josh. So mortgage rates have been rising just a titch, and this week they are up to 6.26%. That is up 2 basis points from a week ago. And these are still pretty close to the lowest levels that we've seen in a year. But there are some signs that right now buyers are not responding as rates move higher. We are starting to see mortgage applications fall a little bit on both the refinance side and the purchase side. We're also headed in toward the end of the year, and typically we see home buying and selling just really take a break for the holidays, and we're almost there.
Did lower mortgage rates, though, did it attract some buyers in October?
Yeah, so we did see a pretty big uptake in what we call existing home sales, and they were up 1.2% from September to October. And I thought that was pretty interesting because we had the government shutdown during the entire month of October. And a lot of people were saying, with the government shutdown, there were delays in certain types of government-backed mortgages. People were nervous. That doesn't seem like the best time to buy a home, but you know what? Those lower mortgage rates in the month of October seem to really help.
Finally, Claire, listen, affordability, we know is still a pain point. How is that just impacting buyer-seller dynamic?
Yeah, so right now we are what is considered to be a strong buyer's market, at least by Redfin. They say that there are 36.8% more sellers in the market than buyers. And normally in those cases, you see buyers gain power, prices are going to fall. But we're in this really weird point in the market where that's just not happening. And as a result, buyers are really not able to afford homes. And so we continue to really be in this standstill right now until we see mortgage rates or prices fall. And, like I said, it's pretty much the end of the year. Things are slowing down. So we're kind of hoping for a better 2026 for pretty much everyone in this market.
All right, I'll eyes to next year. Claire, thank you. Appreciate it.
Thank you.
Well, stocks today under pressure, but it's been a strong year. Jared Blickley has a look at stocks in translation.
U.S. stocks are in rally mode once again, but the nation with the world's biggest stocks like Nvidia, Apple, Tesla is getting trounced by countries around the world with much smaller markets. And on today's Stocks in Translation, we're going to take a look at some of the best performing countries in the world and importantly, see if they're still a good buy or if it's simply too late to jump into international waters. Now, it's a remarkable story, especially considering the new tariff regime that was unexpectedly thrust on the world earlier this year. And we recently talked to editor-in-chief of Investopedia, Caleb Silver, about some of the amazing gains around the world. Here's what he had to say.
What's crazy is that these markets have been strong all year despite tariffs.
Yeah.
Now, China is also outperforming the U.S. despite all the threats of tariffs. But even if you look at countries like Poland and Greece, they are trouncing the United States. Not big stock markets, not very liquid, and don't really hold a lot of growth stocks, but they've sort of been immune to a lot of the political and trade and tariff noise that's been out there.
Now let's take a look at the U.S. and some of the big winners around the world. This is the heat map of country ETFs, and it's just a sampling. All returns are year to date. In the bottom right here, we have SPY. That tracks the S&P 500, which represents the U.S. And it was not hard to find 20 countries which are handily beating the U.S. You can see in the upper left, that's Korea. It is heavily levered to the tech trade and chip stocks, so not surprising to see it's winning out here. And check out number 2, it is Greece, up 65%, rising from the ashes of the global financial crisis. And Greek is not even a story about AI or tech, it's about fiscal discipline. And we don't have time to dig into each one of these, but just to let you know who else is on the top row here, EWP is Spain, then EPOL is Poland, both of those up over 60%. Then there's Peru, Vietnam, and Austria to round out that top row. But investors want to know, have these foreign markets gone too far, too fast? Is it too late to jump in? We asked Caleb that very question. Here's what he said.
It is very rare, though, to see international markets outperform the U.S. for an extended period of time. It's very much a U.S. stock market around the world. No, not being nationalistic here, it's just the biggest market and the most liquid in the world. So this is very rare and it doesn't last forever. I wouldn't say it's too late, but I wouldn't go all in or even load up half of the boat with international stocks at this point.
So if you're sitting on some nice gains, you might want to lock in some profits depending on how much exposure you've got. And if it's a small amount, then maybe you just let the investments ride. But if you're thinking about jumping in, you probably don't want to make these a huge part of your portfolio. And it's also helpful to look at how this basket of country ETFs has performed recently. So in the fourth quarter, since October 1st, here we see a different picture. Chile, or ECH, tops the list, up about 14%. And then there's Korea again in the number 2 slot, up 11%. Brazil is in third place at 6 to 7%. Then Spain, Poland, and Hong Kong are each up about 2% or less. The biggest loser in the fourth quarter is China. It is down by 7%, followed by Germany and then the Netherlands. And you might be thinking, wow, there are really a lot of tickers here and choices. So where do I begin? Caleb feels you, so let's listen to what he had to say.
But you don't have to go out and look at the map and go put pins in them and try to pick them individually. Buy the MSCI All World Index. Make it a part of your portfolio.
So picking individual countries can be difficult, maybe as difficult as picking stocks. So that's why he's recommending a much broader approach. And here are a few options right here. You can invest in an ETF that tracks the entire world ex-US, which includes no US stocks. That's what ACWX is showing right here, up about 25%. You're not getting the eye-watering returns of South Korea, but you do have a little bit less volatility. And if you're only interested in developed countries or emerging markets, you've got some options there too. SPDW, that contains all the stocks in the developed world except the US. And EEM is one of the oldest emerging market ETFs. But be careful, as it's weighted very heavily to China, as are many emerging market ETFs. So if you don't want China, but you do want EM, you can go with EMXC. For that route. Now, all of these options happen to be up over 25%, which is still double the US. Now, finally, here is a checklist of things that you might want to consider before jumping in or even just kind of reviewing your trades. Number 1, do tariff headlines still get ignored? That's a big one. Then, are US mega caps regaining momentum? And then, are you overloading one country or theme? And finally, how's the US dollar doing? Is it weak or is it getting stronger? Tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
The labor market showing unexpected strength in September with 119,000 jobs added. Meantime, though, the unemployment rate ticked up to its highest level in nearly 4 years. Joining me now is Diane Swank, KPMG U.S. Chief Economist. Diane, always great to see you. So let's dig right into this, Diane. So U.S. job growth picks up, but the unemployment rate did tick higher. Does that fact, Diane, the unemployment rate ticking higher, does that, in your opinion, increase the odds of a cut from the Fed next month?
It doesn't, because we still don't get a lot of economic data. And in fact, underneath the hood, the unemployment data was actually better than expected. The reason we saw an uptick in the unemployment rate was because an increase in participation. The U6, which is a stress measure, it includes all discouraged workers, people who haven't looked for jobs in a while, people having to take part-time instead of full-time work. That actually fell during the month from 8.1 to 8%. It's not a big decline, but that's welcome news in the underlying data. And this data is somewhat stale at the end of the day. And that's the biggest problem for the Fed in terms of making their decision next month, because they're going to have very little data that comes out before the December 10th meeting on both inflation and the labor market. The updates on the labor market with revisions to September, a little bit of payrolls maybe for the month of October, and then the November payroll number is not out until after the Fed actually meets on December 10th, and we don't get much inflation data either.
Diane, let me ask you, if you were on the Fed next month, would you cut?
I would wait until January to see where we are, even though I am very worried about the labor market. I'm also worried about the fact that inflation's gotten more dispersed. We're seeing it in places that aren't unrelated to tariffs. We're seeing something that the Federal Reserve referred to as opportunistic pricing, which is when competition is reduced due to tariffs, and then even goods that are not due to tariffs going up in price. That kind of contagion is something the Fed doesn't want to see, and they do know on the cusp of next year is in the beginning of 2026, not only is there talk of those $2,000 rebates, but more importantly, we're going to have record tax refunds. That's because of expansions to tax cuts that were added into the One Big Beautiful Bill Act in July. They did not change tax withholdings, so they will do that again at the beginning of the year. That's another tax cut. And so that fiscal stimulus will be coming at the same time that tariffs are having some of their biggest effects. And we also see some more dispersion where in the service sector, things like childcare, in-home elder care, those went up at the third and the fastest rates on record in the month of September. And those are things the Federal Reserve is worried about.
You know, Diane, one argument I've heard, and I'm curious to get your response to this, you'll hear this argument. They should cut, folks will say, because the labor market needs it, the housing market needs it, low-income consumers need it, and you know what? If inflation got away from them, they could always take that cut back. What do you say to that?
Well, first of all, I've heard the argument a long time about the idea that a cut would help inequality. That is just not how federal funds rate works. The short-term interest rate cuts, the percent of that on a subprime loan, which is about 25% of borrowers have subprime debt right now, those loan rates are so high that the marginal cuts you get from the Fed, they accrue more to wealthy households in terms of how they affect the equity market, and wealthier households who have lower rates. And so they have made a larger share of their payments rather than a subprime payment. So it doesn't deal with those issues. And in terms of the labor market, I am worried. But what I don't know for sure, and this is what the Federal Reserve is looking at too, is how much of the labor market weakness is due to structural factors like curbs on immigration, the supply of workers being constrained, or on AI, different kinds of factors out there that they have no effect on by just reducing the interest rate alone. At the same time, they do know more fiscal stimulus is coming. So this is a very difficult time when the Fed, instead of just a dual mandate of full employment and price stability, they have what we call a dueling mandate, where prices are edging up at the same time unemployment is edging up as well.
One question being asked, Diane, is should the Fed change the date of that meeting next month, adjust it so that they can have the data they need before making that decision? What do you think?
I don't think that they can change the date. It's very hard to change the dates of these meetings. And so that's a real problem. If they wanted to, and they got something that was startling on December 16th, they could always have an emergency meeting and do an emergency cut. So it's not as if all of a sudden we got absolutely horrible data on December 16th, that the Fed would have to necessarily wait till their next meeting in January. They could always turn around and do an intermeeting cut if they really thought it was warranted. And they're really worried about something that was, say, a larger meltdown in the broader stock market and credit market in particular. What the Fed intervenes on is when things become disorderly and threaten to have a much larger scarring effect on the economy. And so I think that's important to remember, that if something were to surprise us totally on the downside and really be awful before the end of the year, the Fed always has that ability to call its own intermediate cut.
You know, Diane, we got that earnings report from NVIDIA, which of course is the face of that AI trade. How important, Diane, at this point is that AI trend theme build out for the broader U.S. economy?
Well, right now there's a 45% backlog on data centers just going into 2026, and that's above the levels of 2025. AI alone and the wealth effects, the infrastructure build out, the electricity grid needs, and then the wealth effects it's generating, that is accounting for the overwhelming majority of growth in the U.S. economy. And it's one of the reasons why we don't feel very good about the economy. We have all this economic growth that's concentrated in the hands of just a few firms and a few very affluent households. And that's why you're seeing consumer confidence numbers, because many people who have a job are clinging on, and those who don't have a job are still wanting. That is why you're seeing an economy that looks so much better on paper than it feels to the overwhelming majority of households. And what's so stunning is to see concerns about inflation and the job market both elevated. We've not seen that duo together, that toxic mix, which has a stagflationary whiff to it, since the 1970s. It's nothing as bad as the 1970s, but that's why there's so much tension within the Fed, and the Fed itself is very divided about the decisions it's going to be making on whether or not to cut rates anytime soon.
Diane, always great to have you. Thank you.
Thank you.
Coming up, Walmart topping Wall Street's estimates in its latest quarter. What does this tell us about the health of the retail sector? We get an analyst take. That's up next. While Target pointed to signs of struggle amid the uncertain consumer environment, Walmart has been able to rise above and deliver third quarter results that did top Wall Street's expectations. The retailer also lifting its full year forecast. For more on the divergence in retail, let's welcome in UBS U.S. Hardline, Broadline, and Food Retail Analyst Michael Lasser. Michael, great to see you as always. Let's dig right into this Walmart report, Michael, because they reported investors like what they had to say. Stock's up about 6.5% right now. They raised their full year sales and profit outlook. I know you have a buy on the name, Michael. Give us your take on the print.
Our take on the print is that Walmart's hitting on all cylinders, Josh. Like you said, it comped up 4.5% in the U.S. It generated significant profit growth, well in excess of the top line growth. And we think it's still left room for estimates to move higher in the fourth quarter and moving into 2026. Walmart right now has a lot of control over its destiny. There are not many other retailers who stand in that same position. Most of them are going to be at the whim of the macro. While Walmart will be influenced by the macro, it has so many levers as it can pull that it can drive through what is going to happen in the broader environment.
What are those levers, Michael? Because that's what I wanted to get at with you. How are they seeming to navigate macro pressures better than rivals?
It's really across the organization. They're investing in price, assortment, value, and convenience, as well as experience. Their e-commerce business grew in the 20% range in the most recent quarter. That accounted for 440 basis points out of the company's overall 450 basis point same-store sales increase. They're doing that by speedier delivery, having more products available online, making those products at more compelling prices. So it's really a combination of all that. Walmart's come a long way over the last few years, and we would expect that to continue.
These changes in the C-suite as well there. So Doug McMillan retiring next year, John Furner taking over. Is he the right guy to take over, Michael?
There's no question. John, as the heir apparent, he will do a very good job. We are excited about his leadership. He's proven himself not only by leading the Walmart U.S. business, but the Sam's Club business as well. We expect this transition to be quite seamless.
All right, let's switch gears here because I also want your take on Target. Now, they reported yesterday, lower the top end of the profit outlook. Comparable sales contracted more than expected. What do you make of that report, Michael? Where is the softness coming from here?
So Walmart's trying to find its way. It had outperformed during the pandemic, had not invested as much as it should have in areas like e-commerce fulfillment, merchandising, and it's trying to play catch up. A lot of the message that it's offered up until now has been focused on accelerating what makes Target Target, offering new and exciting new brands as an example. And we just have yet to really see the benefit of some of those actions. Also, the in-store experience is not where the consumer has expected it to be. In-stock levels have been far below where they should be. And so Target's working on trying to improve that. That's the reason why the company comped down nearly 3% and had to lower its guidance, although that was not unanticipated. It does now mean that it's moving into next year, it's going to have to accelerate the gains and accelerate the progress from some of its actions in order to improve its performance.
Talking about the in-store experience there, Michael, it looks like they do plan to raise capital spending to $5 billion next year, remodel stores, open new locations. Is that the smart move in your opinion, financially and strategically?
It is the right move. They're going to have to remodel stores, elevate the assortment, ensure that they're offering the right value. The challenge when you get in the retail sector is that there can be these cycles where if you don't grow your sales, then you'll have to pull back on some resources that can decay your experience for your consumer, that can drive your sales down. So trying to break that cycle is where Target is at right now. It's obviously got a new leader in charge who will be guiding the company as they try and reverse these trends, and that the pressure will build on Target moving into 2026.
Final question, Michael. We're always looking for lines of sight into the consumer. Based on your coverage universe, you got the Walmart report, the Target print, and others. How would you characterize the consumer, Michael? How healthy? How resilient?
Resilient and steady. But choiceful. Those are the words that we would use to describe the consumer. By and large, a lot of the trends that we saw in the third quarter were similar to what we saw in the second quarter. There's some pockets where consumers feeling a little bit more pressure, like that lower income consumer, and especially to start this quarter as some of the government actions had weighed on the spending power for that income demographic. But by and large, the consumer right now is steady.
Michael, always great to have you on the show. Thank you.
Too. Thanks, Josh.
Well, we'll wrap up today's Market Domination. Don't go anywhere. Got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.